Inside the Rope.
Thank you very much, David.
Howard, we have a little tradition on the podcast where we ask guests to introduce themselves. However, in your instance, given your stature in markets and the degree to which you're known across financial markets, it feels a little bit redundant. However, for this special fireside chat episode of Inside the Rope, perhaps you could introduce yourself. Who is Howard Marks?
Well, I'm a kid from New York who was fortunate to go to Wharton in 1963 and then University of Chicago. That means my education was both qualitative and practical at Wharton and then theoretical and quantitative at Chicago. It was a great combination. I came out in 69, went to Citibank uh, in the equities research department. Um, and The bank was a devotee of what was called Nifty 50, the best and fastest growing companies in America. If you bought the stocks the day I got to work in September of 69 and you held them for 5 years, you lost about 95% of your money. And the result was so bad that I was banished to the bond department, which was the equivalent of Siberia. And uh, I was asked to start a portfolio in something called high yield bonds, if I could figure out what that meant. And they were considered very, very improper, uninteresting, shady, um, and and I did that. And now I was investing in the worst public companies in America and making money steadily and safely. Um, and My whole career has branched out from that, Dave. Uh, Starting high yield bonds in 78, which was the beginning of the high yield bond world. It's great to be in at the beginning. Distressed debt in 88. I moved to TCW and teamed up with Bruce Karsh, and we started the I think the mainstream world's first distressed debt fund. Then we left in 95 to start Oaktree. We just celebrated 30 years. Oaktree has 200 billion under management in what are called alternative investments, mostly related to credit, either performing credit or distressed debt. Um, we do a few other things as well, and I think that's the bulk of it.
And Howard, what led you to starting Oaktree? And I think it was you and maybe four others.
Right. Well, there were a couple of things. Number one, we work in a place called TCW, and they did 50 different things, 50 different ways, and we had a very strong opinion on how money should be managed, and we didn't like that unfocused approach. We wanted to have a place that ran our way, and so that was on kind of on the high side of the reasons, and then on the low side, we just thought we could make more money. And when we got into the distressed debt business in '88, and we're now earning 20% of the profits if we can do a good job, we couldn't figure out what they did to deserve half of that, which is what they demanded. So we left, and as they say, the rest is history.
It seems quite fortuitous that being relegated across to the high yield market of Siberia in the day seems to have worked out well for you.
Right.
Um, Howard, um, what would you say? What events and or people have been the biggest influences on your career and thinking?
Well, the early events that I described had a tremendous effect, Dave. Um, when we lost so much money in those supposedly great companies, it taught me that in good investing is not a matter of buying good things, but of buying things well. It's not what you buy; it's what you pay that matters. And then going into high yield bonds, which were, like I said, considered shady junk bonds, and having such success so steadily, uh, what it basically convinced me is that there are very few assets which are so good that they can't become overpriced and dangerous, and there are very few assets which are so bad that if they're cheap enough, they can't be a good idea. And so, my whole career since then, that was 47 years ago. And my whole career since then has been a matter of basically, when possible, doing the things that other people don't want to do, uh, taking the risks that other people don't want to take, doing it carefully. And, that I think that's what you have to do to get a special return. It's easy to get an ordinary return, the returns that everybody else gets by investing in a given market. If you want to get a special return, you have to do something different. And that was my route.
And how you've mentioned the word distressed and distressed debt, and I think you've probably most synonymous within markets for your expertise in that area. But for the average investor or the investor starting their wealth management journey, just the word distressed debt or that title would actually be something they'd be quite fearful of. Why is it something that they shouldn't be fearful of and something that actually can produce solid, low volatile returns with low volatility?
Well, if you lend money or buy the debt of a company, and the company, the borrower, promises you that he'll pay you interest every 6 months and he'll give you your money back at the end. That's how debt is reckoned. And if he doesn't do that, then he basically goes bankrupt. And the point is, which sounds a little counterintuitive and kind of plays into your question, is that just because he's bankrupt doesn't mean his debt is worthless. A creditor who hasn't been paid, satisfied, we say, has a claim on the value of the estate. And they use the word estate in law, just like a dead person. And there's an estate, and the creditor who hasn't been paid off has a claim on it. And if you can figure out what that claim is worth and buy the claim for less than it's worth, then you can make good money, and you can do it safely, steadily. And so, again, I talked about the attractiveness of doing the things other people don't want to do. Uh, Historically, people were scared off. They said, who would ever want to buy the debt of a company that's bankrupt? And if they didn't want to buy it, that usually meant that I could buy it cheap. And that's what we did. And my partner, Bruce Karsh, runs the distressed debt group and has done from the beginning 47 years ago. And, his funds have made 22% a year on average before fees and 16% after fees, without using leverage. So in other words, those were the actual returns on his investments. And that's an incredible accomplishment. But it just goes to show you what can happen when you buy things on the cheap. If you buy the things that are the converse, the converse of buying things that have that tinge of bankruptcy, the converse is buying the things everybody loves, that everybody thinks are safe. But if they love them and they think they're safe and they're bidding to buy them, you really can't expect to get a bargain. You get a
I'm
bargain on the discards pile.
I'm intrigued to get
And
into
and
the
that's really the difference.
I'm intrigued to get into the behavioral aspects of what you're talking about here. But before I do that, I'd like to sort of talk to you a little bit about your memos and what sort of inspired you to do that. And before I do it, I'd read a quote, and it's not often that you read a quote from Warren Buffett on this podcast, or I do anyway. And he said, "Look, when I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something." I think that's a really outstanding, fantastic quote that must make you proud when you reflect on it. Um, what motivated you to start
Makes my
writing the
mother
memos?
proud.
Howard?
Um, you
What
know, uh,
motivated you to start writing them in 1990?
what started me was just a juxtaposition of two events, and it was very interesting. And I just thought it was interesting, so I wrote it up for my clients. I had dinner in Minneapolis with the head of the General Mills Pension Fund, Dave Van Benschoten. And he had been the head of the pension fund for 14 years. And he told me that in those 14 years, General Mills equities, stocks, had in every year been between the 27th and the 47th percentile, never above the 27th, never below the 47th. So solidly 14 years in a row in what we call the second quartile. And so if he's solidly in the second quartile every year for 14 years in a row, well, where do you think he was for the whole 14 years taken together? Well, you might say, well, let me think. Sometimes 27, sometimes 47. So probably on average about 37. No, fourth percentile overall, all the pension managers in the world. Why? How do you get up to the fourth percentile if you never have a single year outside the second quartile? And the answer is most people are not that consistent. They can't do it steadily. And in fact, most people shoot themselves in the foot. And if you can invest steadily and not do that, you can be among the very best without taking great risk. Well, at the same time, another money manager in New York had a so-called deep value manager who invested in a lot in the banks, and the banks had a terrible year. And they had a terrible year. And, you know, I don't know if you've noticed, Dave, but investment managers are pretty facile. And they're pretty good at coming up with rationalizations. And this guy had a great rationalization. He said it's simple. If you want to be in the top 5% of money managers, you have to be willing to be in the bottom 5%. And my reaction was, my clients don't care if I'm ever in the top 5%. They absolutely don't want to see me in the bottom 5%. I like Dave Van Benschoten's approach better, steady and consistent and never terrible. And so I just thought that the juxtaposition of those two events was so powerful that I wanted to tell my clients about it. That was it. I didn't say, oh, I'll write them periodically. I'll write them for the next 35 years. I'll write for a year or quarterly, or it'll make me any money. I just thought it was interesting and I wanted to share it.
And how many are you up to now?
I would guess about 180 over 35 years. That's about 5 a year.
Terrific legacy and learning. I know it was one of the things I pointed my son to go through and read and or listen to as he educates himself through the finance world.
Thank you. By the way, I'd like, Dave, if I can, I'd like to tell your listeners that they're all available at oaktreecapital.com under the heading of Insights. You can read the last 180. You can get a subscription to the future ones. And the price is, I'm sure the price is right because it's free. And the other thing is that if you go on the website and you sign up for them, we will not use your information as a mailing list for marketing. So you won't get any junk from us. And I hope people will listen.
I'm sure they will. And I know they can actually listen to it in podcast form as well. If they're listening to the podcast, it's a good chance they like podcasts. So there's one for them as well. And they probably don't even need to listen to the last memo about the calculus of value to work out that the value on that one is absolutely right.
Right.
So Howard, you've often said, and you've alluded to it in our discussion so far, about successful investing is more about psychology than economics. Can you elaborate on that? You have a little bit, but I'm keen to understand what you mean by that and how you can pull that apart for the listeners.
Sure. Investing is not like building a bridge. You want to build the bridge, you calculate how much concrete there has to be and how much steel, and if you put it in there, it's going to stand up. Investing is more like, I don't know, maybe even jujitsu, where you have an opponent and you want to knock him out, he wants to knock you out, and you sometimes you use his strength against him, and or Or it's like golf. What matters isn't the score at the end of the round. What matters is whether your score is lower than the other person's score. It's a relative game. What we're in this business for is superiority. We want to have a higher return than the other person, but they want to have a higher return than us. So we have to outthink them in some way. And 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 I say outthink, but one of the great ways to do better in investing is by managing your emotions better than they do. Human emotion tends to uh, get people excited when things go well, making them want to buy at high prices, and makes them depressed when things go badly, making them want to sell at low prices. And both of those things are the opposite of what you should do. So obviously, you have to master your emotions. And if you can do that better than others, that's a huge advantage. And I have always felt, like I implied in my answer to your earlier question, that one of the maybe the easiest way to achieve superiority, if you're capable of it, is to do the use other people's psychology against them, do the things they don't want to do, and leave to them the things that they want to do and everybody else wants to do, and consequently are high priced. I like to say that I buy my underwear when it goes on sale at the department store, and I think it's a good strategy, and I prefer to apply that to my investing as well.
And how do you maintain that discipline? I think it's easy to read, and I think over the 204 episodes of the podcast we've had many behavioral economists on, and we've talked about sort of the Daniel Kahnemans of the world and their sort of thinking. Who, if I read his work correctly, he's almost saying, there are these heuristics and behavioral traps that you can't avoid. You've just got to
Right.
understand that you're going to be a victim to them. How do you, or how could you encourage investors to develop and maintain a psychological edge?
Dave, I've recently come to the conclusion that all the hard questions in the world start with the word how, or
Hmm.
the hard questions in my world. I can tell you what you have to do. I just can't always tell you how to do it. People say to me, "Well, how do you overcome your emotions?" I can't tell you how, but I can tell you why it's important, and I can hope that you'll learn to do it, um, and so forth. You know, I like to practice something I call second level thinking,
Hmm.
which is thinking different from other people and better, deeper, more nuanced. But I can't tell you how to do it. In my book, The Most Important Thing, where Buffett supplied that lovely quote for the jacket, uh, and which I wrote at his suggestion, by the way. Um, I say, I can teach you, I can tell you why. Look, you're not. If you think about the fact that investing is about outperforming the other person, then clearly to do so, you have to think different from how the other person thinks and better. I just can't tell you how to do it. And I
So
say
that's
in the book, it's kind of like in basketball, they say you can't coach height. All the coaching in the world won't make your players any taller. And that's kind of the way it is. Some people have superior insight and are able to think different and better, but most, by definition, are not.
Howard, you touched on the second level of thinking that you've written about extensively, as being essential to outperforming. Can you give a few examples of that sort of second level thinking that you promote within Oaktree and have used yourself to such great effect?
Sure. Well, first of all, you have to start, Dave, from the assumption that if you think like other people, you do the same things that everybody else does. And if you do the same things that everybody else does, that's not a very good route to superiority. You have to do something better if you're going to be superior. And so, an example, I always say, my son, who wanted to be an investor, would come home from university on break, and he would say, "Dad, we should buy Ford stock because they're coming out with a great new Mustang." My question for him was always the same for educational purposes. I would say, and who doesn't know that? So the point is, if Ford's coming out with a great new car and everybody knows it, then they have probably reflected that fact in the price of the stock. It's no longer cheap. The question is not whether the news is going to be good or bad. The question is, are you getting whatever the news will be for less than you should have to pay? If you pay full price, you're not going to have a superior return. If you pay a too high a price, you're going to have an inferior return. So again, it's not the absolute, it's the relative. And so you just have to develop the discipline of a look. The question is always, what do you know that somebody else doesn't know? And if you don't know anything that the others don't know, if you don't know something that the others don't know, how the hell are you going to outperform? You have to have what I call a knowledge advantage to outperform. It's not. This is not. Investing is not a field where you do better if you try harder, or if you put in more hours, or you apply more elbow grease. You have to have some kind of an edge, and the edge is informational, and it comes from seeing things that other people don't see, and that's second level thinking.
And Howard, do you think there is a discrepancy in the knowledge advantage that's available in public markets versus private markets?
Well, this is a great question, Dave, and you know, when I went to Chicago, as I mentioned in the introduction, the most important thing I learned there was something called the efficient market hypothesis. And basically, what it says is that in the investing world, there are thousands of people trying to make money, and they're all, or let's say lots of them, are intelligent and computer literate and hardworking and highly motivated to make money. And their efforts, their combined efforts, cause everything to sell at a fair price. And one of the conditions for that is that everybody has all the same information and complete information. And again, like I said, you know, your great successes have to come from some kind of an informational advantage. So, you know, Buffett talks about the fact that he used to be able to buy dollars for 50 cents because he would do work that other people wouldn't do. And in the old days, when information was not widely available, he would just outwork the others and get more information. Today, that's not possible. Today, the SEC operates something called Reg FD. FD stands for fair dealing. They want everybody to have the same information at the same time. So the information imbalances are now scarcer than they used to be. And you know, when I was beginning in this business, I'm not as smart as Buffett, so I may have to pay 60 cents for some of my dollars. But believe me, you can't do it anymore because there are too many other people who are trying hard, who have information, and are willing to put it to work. So yes, in public securities, everybody's supposed to have the same information, and generally they do. And so one of the ways that we've tried to get an advantage in the past is by investing in private assets, companies, private debts, things like that. The only problem is that doing that has now become popular. So that market is more crowded, and even there, it's hard to find dollars for less than 100 cents. So again, if you think about investing as being a battle between you and somebody else, it has gotten harder to find that advantage. And you have to bear in mind that just effort is not going to pay off. You have to have an edge.
Makes sense. Now, Howard, you've often said that you can't predict the future, or you can't predict, but you can prepare. What does
Right.
preparing look like in the current environment?
Well, first of all, let me clarify what I mean by that. And I did write a memo, I think around '02 or something. You can't predict, you can't prepare. And it's the tagline, the advertising slogan of one of our insurance companies, the Mass Mutual Insurance Company. I heard it on a football game. I thought it was very useful for these purposes. Now, you can predict the future, and most of the time, I can tell you how the economy is going to grow this year, and I'll probably be right. The trouble is, everybody else is going to be right too. So my economic forecast is unlikely to be a source of outperformance. Um, so we don't have an economist at Oaktree, and we don't invite famous economists in to have lunch, because none of them has an advantage either. And if you say to yourself, where are all the rich economists, that'll give you a hint what I'm talking about. There aren't many around. And so we don't think that we are going to get an edge and be able to outperform other investors because we're better macro forecasters. Macro means, the economy and interest rates and commodity prices and currencies. Those are called macro considerations. We try to outperform by knowing more than other people about the micro companies, industries, and securities. And we think we can outwork them. And one of the reasons that Bruce Karsh has been so fabulously successful in his distressed debt investing is that he and his team read the court cases and read the debt indentures. And maybe other people may not do so as thoroughly, and maybe our team can pick up something. Maybe there are two pieces of debt and they're both described as senior debt, but maybe one has priority over the other. And if you're willing to spend, an hour reading some dry legal prose, maybe you can figure that out. Because in the private markets, the information is not uniformly disseminated. The SEC Rule FD doesn't exist with regard to the private markets, and so it's still not easy to make superior returns, but maybe you can get an edge in the private markets that you can't get in the public markets.
Howard, I'm intrigued to understand your attitude around gold, given what I would see as an investment framework that's quite fundamental and cash flow orientated. And I think you wrote about it in your memo in 2010, All That Glitters. But how
Right.
does gold fit into your investment philosophy? Given that from my perspective, this
Well,
is probably a selfish
sure.
one for me to ask. I've always thought of investments as the sum of their future cash flows, and the capital growth, and therefore quite fundamentally, gold actually costs
Right.
me money to store. Why do I want to own that?
Well, you just answered your own question. Um, I am, we are what's called value investors. And what value investors do is that they believe they want to make investments in things that have intrinsic value, and they believe they can estimate the intrinsic value. And and what you said about the kind of investments you want to make, if something has cash flow, you can put a value on it. Now, let's say there's an apartment house, and it produces rent income of $2 million a year, and it costs $1 million a year to operate and to service the debt. So it throws off a profit of a million a year. What is that worth? Well, you can say, I'll pay 10 million for that. And if you pay 10 million and you make a million a year, then you get a 10% return. That's pretty good. Somebody else may say, I'll pay 8 because they want to return over 10. Somebody may say, I'll pay 12 because they're happy with the lower return. But the point is, there's a way to put a value on that asset and figure out the price you're willing to pay. But if an asset and cash flowing assets include stocks, bonds, companies, and real estate. They throw off cash flow. Assets that don't produce cash flow, what are some examples of that? Gold, diamonds, paintings, furs, oil, sports cars, and Bitcoin. They don't produce cash flow. So you can't talk about what's the fair price. Now you can believe that, for example, you can believe that Bitcoin is going to go up in price or gold. And so far, the people who believe that Bitcoin is going to go up in price are right, and they've made a lot of money. But they still didn't make it analytically or scientifically or systematically. They took a punt, is what they say in England, and they got lucky. But what is a Bitcoin worth? Can't say. What is a Picasso worth? I can tell you what the last one sold for, but I can't tell you what the next one's going to sell for because I have nothing to base that on. These are assets that what we say is it's whatever the market will bear, right? Whatever the buyer is willing to pay. But there's no science there, and so you can't do that analytically or safely or dependably. You might get lucky, and in the memo that you mentioned, all the glitters, I said you can invest in gold out of superstition. We do lots of things out of superstition. You can invest in it because you think it might go up, and if you don't own it, you'll kick yourself. Or you can invest in it for any of a number of reasons, because you're afraid to be wrong. That motivates a lot of people, FOMO. But you can't analytically put a price on an ounce of gold. So I agree with you 100%, and I'm willing to not make money in gold. I'm willing to watch other people make money in gold, and not me, because I don't think it can be valued analytically.
Well, your vernacular will certainly resonate with our predominantly Australian audience, Howard, in that we certainly know how to have a punt in Australia, and there's plenty of
Right.
evidence to suggest that. Talking about valuations and
But by the way,
cycles,
let me just say one thing about gold, which I think I said
sure.
in the memo, although it was 15 years ago. What I said is, you take gold, you take out the L, and what do you have? You have God.
Hmm.
And there was a guy named Stephen Chase, and he said, not necessarily about religion, but he said, for he who believes, no proof is necessary. For he who does not believe, no proof is possible. And that's the way it is with gold and other non-income producing assets.
Howard, talking about the current cycles and current cycles, in one of your recent papers, you spoke about, introduced this concept of InvestCon, which I quite liked because I could remember it easily. I think you actually said, that if you watch these movies, where there's action movies, which I actually quite like as well, where there's always a CIA, and they have a sort of a DEFCON rating, 1 to 5 of 1, be alert, and
Right,
5,
right.
thermonuclear. And you introduced this concept of InvestCon. Perhaps you could break that down and then you think of maybe where we are in the cycle today.
Sure. Well, um, uh, my wife and I do like those movies, and we watch them all the time. And the bad guys are coming, so they say, "Well, we're going to go to DEFCON 2." That means spin up the nukes or something like that. We're going to go to DEFCON 1, and et cetera. And so you know, I speak on TV a lot, and I'm interviewed with the papers, and people always say, "Well, is it a buy or should we buy or should we sell? It, risk on, risk off." And I find these binary um, ways of looking at things very unsatisfying because things are not usually black or white; they're gray. So if you, as you say in this memo, calculus of value, I talked about the def cons and I talked about the invest cons. So you know there's a continuum of actions you might take. I think, just to step back a minute, I think that if you want to think about how to manage your affairs in the short run, now you can in investing you can legitimate say I don't give a damn about the short run. I'm going to manage for the long run. I'm going to live with the fluctuations and the ups and downs in the long run, in the short run, because I know I can come out well in the long run if I can just pick good companies and so forth. And that's totally legitimate. We call that buy and hold. But some people want to be right in the short run and they want to pick off these opportunities. So if you want to manage your money with an eye toward the short to intermediate term, in my opinion, the most important dimension to deal with is the dimension of aggressiveness versus defensiveness. At a given point in time, relative to your normal risk posture, should you be more aggressive than usual or more defensive than usual? And I think that's a productive way to think about it. So, and in this particular memo, I expressed the opinion that I think it's time for a little defense. That doesn't mean you sell everything you own because it's not black or white, but maybe you want to be a little more defensive than usual. So, what can you do? Well, InvestCom 1 was you stop buying. InvestCom 2, you sell some of your aggressive holdings and you buy some more defensive holdings, leaving aside for the moment how you do that. InvestCom 3 was you sell off all your aggressive holdings. InvestCom 4 was you also start selling off your defensive holdings. InvestCom 5 was you sell everything, and InvestCom 6 was you go short the market. You bet that it's going to fall. So I think it's helpful to think about these things as a continuum rather than black or white. And that's what I was trying to do there. A lot of people enjoyed that.
One of the things I really enjoyed out of that memo was really the thinking and clarity around the S&P 500, which I think you pointed out appears on historical standards to be quite extended. And then you broke that down further to sort of talk about the Magnificent Seven, these big technology companies that we all know, whether they be Alphabet, which is Google's head, or Meta, which is Facebook's head, or Apple or Nvidia, etc.
Yeah.
The fact that they were trading at something like 33 times forward earnings, which, given their growth rate and the prospects that we believe they have in front of them, might be quite reasonable, which probably makes the other 493 look really unattractive. So I was only commenting to one of my partners the other day. So it's an interesting part of it. So thank you. Howard,
Sure. Well,
go ahead.
yeah. No, you go ahead.
I was going
I
to
thought
ask,
you
look,
had a question, but
yeah, I do. If you could relive one market cycle with the knowledge that you now have, which would it be and what would you do differently?
Well, look, I mean, we've been attuned to this stuff for 50 years, and I think we've done it quite well. We've lived through 4 crises, and the returns on the funds that invested in the crises were better than any of the others. But I guess an example of things not working out as we expected would be the pandemic, because the pandemic scared the bejesus out of everybody, and most people, expressed a little caution, and we even raised the largest distressed debt fund in our history or anybody else's history. We raised $18 billion for what we called our Opportunities Fund 11. But what nobody told me, and what I didn't know, is that the actions of the Fed and the Treasury to stabilize the economy would be so successful. And here we were, we had this terrible thing happen in 2020. We had this thing called the pandemic. We had millions of people die. And guess what? It turned out to be a great year in the markets. And so, I mean, that's an example of something you would have done differently if you could have. But I don't think it's reasonably possible to do it differently most of the time. And that's why I don't like to hang my success on macro forecasting, because I didn't think it was going to be so great. I thought we'd have some good events, but I didn't know it was going to be that good. And nobody else can do it either. So that's why I try to stick to my motto is know the knowable.
Mm-hmm. Makes sense. Makes sense. And Howard, through your career, has your attitude towards how you measure or define risk changed?
Well, I mean, it wasn't highly formed before, and I would say it's formed now. So I guess that's changed. But it's not like I had it's not like I had a certain perception that I had to change. I had really no perception, or I had everybody else's perception that risk is this bad thing and you want to avoid it. And what risk really is, risk stems from the fact that the future is unpredictable. And there's the risk that you'll put some money out and a bad thing will happen and you'll lose it. There's also the risk that you won't put money out and nothing bad will happen and you'll wish you had. So risk is uncertainty, and risk cuts both ways. And I think that investors take risk. If you don't take risk, you don't make much of a return. You can buy treasuries in our country or in your country, and you have no risk, and you don't have much of a return either. So we don't want to practice risk avoidance. We want to practice risk management. We don't want to not take risk. We want to take risk intelligently. And I guess, Dave, the greatest example, the luckiest example, I remember I said I started the high yield bond portfolio at Citibank in 1978. In 81, I think I had my first TV interview, and I was interviewed by one of the first financial cable networks. And the reporter asked me a question that I had never been asked. She said, "How can you invest in high yield bonds when you know some of them are going to default?" Great question. But for some reason, the perfect answer came to me. And I said to her, the most conservative companies in America are the life insurance companies. How can they sell people life insurance when they know they're all going to die? Right?
Mm-hmm.
And that's, if you think about it for a minute, how the hell can you make a living running a company that insures people against death? They're all going to die. And the answer is, it's a risk that you can take intelligently. How?
Got to price it appropriately, I'd suggest.
Exactly. It's a risk that you're aware of. And I always imagine there's the board meeting of the insurance companies taking place, a big long table made out of mahogany, and all these old guys sitting around the table and smoking their cigars. And some young kid bursts in the room and he says, "You're not going to believe it, somebody died." Doesn't happen. They know they're going to die. And so they can act accordingly. Number two, it's a risk you can analyze. And when I got my first life insurance policy as a young man, they sent a doctor to my house to give me a physical to know whether I was a good risk or not. Number three, it's a risk you can diversify. So you don't insure just skydivers or just smokers or just people who live on the San Andreas Fault. You have a diverse book men, women, desk workers, uh, physical workers, at all different ages. And if you have a large enough sample and it's diverse enough, you can expect a reasonable, you can make a reasonable expectation of what the death rate is going to be. And then number four, you can price the risk, as you said, appropriately, so that even if people die, let's say on schedule, which sounds a little callous, you'll still make good money. You look at somebody like me, and you say, oh, he's probably going to die within the next uh, uh, 5 years, but you sell him a policy on the assumption that he's going to die next year, and he pays more of a premium than he should, and he pays it for a few extra years, and that's your source of profit. So that's the intelligent bearing of risk for profit. And I think it's really important that you shouldn't expect to make money without taking risk. And also, you shouldn't expect to make money just for taking risk. You have to take it intelligently. And I wrote a memo, I guess it was around April of 24, called The Indispensability of Risk. And that's what it talked about.
Howard, you've been very generous with your time. I've got one last question for you, and then we'll let you go. Get on with your summer evening. Joining us there from northeast the USA. I'm interested to know if we've got listeners on, or if you imagine giving yourself career advice if you're starting your advice again, perhaps to someone like Josh Clark, my young guy who listeners knows, edited the podcast back from 2016, who's just starting his career in finance. But if you're starting your career today, what would you focus on in terms of your time and energy?
Well, I would still say try to figure out what everybody else doesn't want to do, and think hard about doing that, and try to avoid doing the things that everybody else is happy with. I think that's the most important thing. But I've been thinking more recently that one of the keys to being a successful investor, we have a saying in football, our football, I don't know if you have it in yours, that you have to play within yourself. In other words, you have to play within your capabilities and not try to exceed your capabilities. What that really means in investing is, if you are a cautious, conservative person, you should not go into high risk investments, because you're probably going to screw it up. And you're kind of, and even if you don't screw it up, you're probably going to be uncomfortable. If you're an aggressive person, you shouldn't play it too safe, because you'll be bored and you'll feel like an underachiever. So I think it's really important to understand your own personality and invest in a way that is consistent with your personality and your values and your views. That's my advice.
Howard, I think that's very fitting and a great place to leave the podcast and our special fireside chat with the Coda team. Howard, thank you very much for your time. Thank you for joining us at Inside the Rope.
Well, I've enjoyed your questions, Dave. It's been a great interview for me. And the next time you go to Rose Bay for a glass of wine, think of me, because I love it there.
It's a great spot. Have a great evening. Thanks for joining us, Howard. Bye.
You too. Bye-bye.